Everyone thought Google was dying, but what if the market is missing one of the best opportunities of the decade? The reason why the stock was dropping is because of fear of AI disrupting Google search. As you might already know, search is the core business of Google and accounts for more than 50% of the revenue. So Google has Alphabet owns the two biggest search engines in the world. So we're talking about Google and YouTube search. But many people thought that if people are using ChatGPT and they're using Grok or Perplexity, they will take market share from Google search. Now, what I do usually, I don't buy into narratives. I don't sell into narratives in this case. I look into the data. And if you look at Google's revenue, we will cover it afterwards with charts, I didn't see anything disruptive in the numbers. So let's look at the revenue. First, we're going to look into the annual revenue. In 2021, it was $220 billion. It raised to 278. And last year, it was 328 billion. Now, if we look at it quarterly, you can see that it's been growing heavily, quarter after quarter after quarter. So it's like year over year. Look, here in in Q2 of 2025, it was 96.43 billion. And Q2 of 2024, it was 12 billion less. So it's double-digit growth. If you compare all of them, it's been growing more and more. This, by the way, is my website, StockPicker. You can visit it on stockpicker.tech. In the last 10 years, it's compounding almost 18% per year. It's amazing. And in the last 1 year, it's 13%. It is growing in double digits, which is more than enough to show that there is no disruption. Let's look at the last earning report. This is the announcement from Google on their website, abc.xyz. And here you can see that the disrupted Google services revenue increased 12% to 82.5 billion, reflecting strong performance across Google Search, Google subscriptions, platforms and devices, and YouTube ads. It's amazing. If 12% is a disrupted business, I don't know what would be a growing business. Maybe Google Cloud. Google Cloud revenues increased 32%. Can you imagine 32% growth? It's 13.6 billion for the quarter. So it's like 50 billion business and it's growing 32%. Okay, the operating income increased 14% and operating margin was 32%. The net income increased 19% and earnings per share increased 22%. Let's look into earnings per share quarterly. Here it is for the last 5 years only. In 2019, it was 51 cents. In Q1, it was 2.94. Now it's $2.33 per share in the second quarter of 2025. Comparing to the second quarter of 2024, it was 2.14. So very solid growth, like around 10% growth. This is for the profit, earnings per share. Okay, now let's look into net income. Again, you can see very, very good increase. Now, some people sold the stock because of the free cash flow dropping. Last year, it reached 24 billion, almost 25. But right now, in the last quarter, it's 5 billion. Now, we can look into something else. We can look into the expenses. And for the expenses, let's look into CapEx. So the CapEx is increasing significantly. And this increase is due to Google Cloud. So Right now, the demand for Google Cloud is so high that they cannot meet it. In the last report, they increased their planned capex from 70 or 80 billion to $100 billion. But that's a good expense, isn't it? Right? So imagine it's like you have a shop and there is a queue in front of your shop and you're out of stock, and then you spend a lot of money to buy the new clothes or whatever you're selling. You need more stock. So you buy more, you're temporarily out of money. So your cash flow for this current day or month drops, okay? But then you will be able to meet the demand. So your future revenue and cash flow and profit and everything is very likely to increase, right? So think about it from this perspective. If Google is investing more in CapEx for data centers and to improve Google Cloud, you can imagine that in the future, maybe next year or maybe in 2 or 3 or 5 years, it will increase their revenue. We already see 32% growth. It will increase their profit and their free cash flow. So I don't really see how this business is disrupted. What I see is a dislocated stock. There is a dislocation. All the fundamentals are going up, okay? But the price is flat and even a little bit down. It was a few months ago. So you need to understand, sooner or later, price will follow fundamentals. It's business. What matters is the bottom line, how much money the business makes. We can say disruption or AI or autonomous driving, robots, whatever. In the end, what matters in the business is the bottom line, how much money the business makes. This is what we need to look for. In the case of Google, I saw a dislocated stock where the stock price is not moving while fundamentals are growing significantly, quarter after quarter, with double digits in revenue. That's the best thing that you can look for in any company. That's why I've been buying. Now, let's look into something else. Let's look into valuation. Valuation, we can see here that the forward PE ratio of Google is 19.23. So we have a 19 PE ratio of one of the best businesses in the world. How about that? Google is right now valued as a retail company, while all the fundamentals are growing. For example, if we look into Meta, you can see the trailing PE ratio is 28, while forward PE ratio is 26. Again, a very good company. I'm not saying Meta is a better company, but the valuation there is already higher. If Google's valuation moves similar to Meta, you can imagine a price close to $300 per share, which is amazing. Now, I'm not saying that it will go there. I don't know. What I believe, and that's why I'm buying the stock, is that in the next 5 years or 10 years, the stock may grow. The price may grow because of fundamentals growing. That's why I'm monitoring fundamentals every quarter. Let's compare Google to Meta here. Okay. As a price. So look, the red one is Meta, the green one is Google. Meta is up this year 33%, while Google year to date is up 6%. If we check it for the period of 1 year, then Google is 22% and Meta is 52%. And that's crazy. Google is one of the best companies in the world. Its business is more diversified than Meta's business, so it has more revenue streams, and it's not so reliant on advertising, although advertising is their core business, obviously, but also they have Google Cloud. They're the third biggest cloud provider in the world after Amazon Web Services and Microsoft Azure. So it deserves higher valuation in terms of PE ratio to be like 25 or even 30. And what if I tell you that there is a sleeping giant in Alphabet that can potentially bring another $300 or $400 billion in revenue in the next 10 years? And this one is not priced in. I'm talking obviously about Waymo. Waymo is Google's autonomous driving subdivision, and it's the only operating taxi network. Here is some news. I wouldn't say it's news, it's like from a few months ago, but look at this. Waymo reports 250,000 paid robotaxi rides per week in the US. Again, 250,000 paid rides. 1 year ago, there were like 100 or on 150,000. And right now, like 4 months ago, they had 250. So the scale here is incredibly fast. So they're scaling so fast that competition is far, far away from them. Now, Waymo is the only provider in the US that is operating. 2 months ago in June, Tesla started doing some tests in Texas, but as far as I'm aware, those tests are done with a Tesla representative monitoring for any mistakes done by their system. And in the same time, Waymo is scaling with more than 250,000 paid rides per week. That's 1 million per month, isn't it? So you can imagine 1 million rides per month. They're obviously the biggest player there at the moment. And I doubt it that there will be only one player. I'm not saying that Tesla will not gain market share. I'm saying that Waymo will surely get market share. That's what I think. I read somewhere that it was between $1 and $4 trillion in 2035. This is the expected revenue from autonomous driving. If Waymo catches only 10% from this, let's say 2 trillion, it's 200 billion. And this is not priced in the stock right now. Google price is not considering Waymo because currently Waymo is a tiny, insignificant part of the company. But from what I see, it may become a very big one. So let's summarize. Google has a resilient business. It's the biggest search engine in the world. It also has YouTube, which is bigger than Netflix at the moment. Its revenue is growing. We have Google Cloud, which is also growing into double digits. Its growth is 32%, which is amazing. Because as you might already know, cloud is a business with very high switching costs. Whenever a big company chooses a cloud provider, it is likely they will stay with that provider because they would need to pay millions to move to another cloud provider. Not only millions in expenses, but also their revenue streams might be damaged if they do that. We have Google Search, YouTube, Google Cloud. We have Waymo coming as a very lucrative opportunity for Google. That's why I've been buying the company. Like, subscribe, see you in the next one.